N Jayakumar joins us, Managing Director with Prime Securities. I've set the tone, Jakes. Normally, as anchors, we ask you a question, but I'm giving you a bouquet right now. What do you want to choose? There is coronavirus, there is budget 10, Nifty 50 numbers.
So I think when the offering is so rich, I think you need to sit back and say, let's just go back to stock picking. I think a lot of this is, so let's get the easy things out of the way. I think the budget is the easiest to get out of the way. Walk in with zero expectations and you'll not be disappointed.
But is it really that easy? Because it doesn't seem like the market is going into the event with zero expectations.
No, the market's, I think, not reacting to any stimulus which they are expecting or not expecting for the budget. In my opinion, there is very limited expectations. There is some tax tweaking which the market is definitely talking about, maybe hoping in some pockets. But none of this, I mean, you've had, for instance, income tax cuts, which have now been factored in and taken for granted, corporate tax cuts. Yeah. But the market on that particular day, including me, we thought it was a big thing. And subsequently, they followed up with a lot of intent. But obviously, the economy has taken its own time. And we shouldn't forget that what's changed in India is more important than what is currently present. And what has changed is the structural way of doing business has completely undergone a change. I mean, today, this zero equity or negative equity projects, which we like to call them, which is where the Indian promoter didn't bring in his own equity, but essentially, used the bank debt to borrowed and used that as his own equity. That formula is completely gone. And with capex being so dramatically down, and the fact that banks are now very clearly searching questions about where's equity. Today, there is no dearth of debt, but until the system is recapitalized with more and more equity coming in from at the promoter level or capitalized in a banking system by the government or private sector banks getting their own capital, the entire lending process has undergone a dramatic change. There's surplus liquidity, but people aren't lending very easily because projects are not able to demonstrate equity. People don't have the risk-taking appetite. You could say animal spirits are dead. So I think there has been a structural change in the way business is to be done. So now for new projects to come, it's going to be a cycle. So the first sign of that is where old projects get bid for, which is the IBC process, where the existing capacities are being taken up by other people who've got some amount of equity, where the JSW is acquiring, Bhushan or Tata Steel acquiring a couple of names or etc. So once that process of resolution goes and capacity goes back to maybe different hands, then people will, over the next couple of years, start talking about greenfield projects and new capacities. So until that time, this system is going to be awash in debt, but not debt ready to lend without equity being shown. So I think that's a big structural change. And if people are going to wish this away, and people have been crying hoarse that the top 10, 15 index stocks are not reflecting the economy. And why will they reflect economy? At the end of the day, the thesis was the big will get bigger, which is what people are playing for, but the earnings aren't, and how long will you keep having money flow? Ratify your thought process saying if everybody invests in the same 10, 15, 20 stocks or the index, everybody will make money. That thesis had to fall. This was what I call the classic Venus flytrap, where everybody walked in and said, we are feeling safe because night or day, hail or sunshine, we invest in HDFC Bank and a bunch of these equivalent ilk. And we're good to go, 15% a year compounded, our portfolio will grow. I think that thesis, to my mind, therefore, I think the index has got a lot of headwinds at this 12.3, 12.4 kind of range. And we may well be in a range which is, to my mind, say 11.5 to 12.5 broadly. So we're on the top end of this range, really. And therefore, where does this money move? As people realize that this hiding in, security in numbers is not the way to move forward, people will go back to stock picking. That's why I said, leave the budget out. Coronavirus is an unknown in a manner of speaking. We don't know really what we don't know, which is that how far this can go.
Intensity.
Yeah, so that's difficult for me to talk about it. Hardly qualified, and to the extent that there is a doctor in my family, I kind of look back and try and figure out if there's something we know. But as I've been told, there's absolutely nothing that we can talk about it. And to the extent that communication from China itself is reasonably moderated and articulated, we're not sure of the impact. So that apart, which is a really unknown, whether it's a budget or it's the market, I think one is fairly clear. You got to go back to stock picking. Instant gratification will not come. So I think to some extent, I mean, there are pockets which give a lot of comfort, but beyond all these noisy kind of inputs, there are a few signals that are emanating.
But Jakes, if I look at the stocks which are at a 52-week high, I've gone beyond Nifty 50. Info Edge, expensive. Bata, consumption but an outperformer. Relaxo, I'm just reading the screen in no particular ascending or descending order. PVR, Jubilant FoodWorks, Hawkins. Now the screen is telling you that, okay, let's move outside the Nifty 50, but the stocks which are now at a 52-week high, even in this mid-cap rally, are largely consumer-facing, niche brand, low debt, high return on equity businesses.
And non-equity diluting.
Non-equity dilutive.
So, you've actually answered the question that in the way I would have done it, which is that you've gone back to fundamentals, right? Where there's limited equity dilution and there is a price or a premium to pay for survival.
Yeah.
I would not say for what is for somebody to say that 60 PE is not too high, but 50 PE is the right number. That's not the argument here. The argument here is there is a price for survival. All the names you've survived, names that you've read out, are names that have not just survived, but increased market shares, maybe not grown at the pace that you would like, but in some sense giving a leg up to the theory that some of the big will get bigger, some of the small will get possibly better. These did not perform well in the past because of this SEBI categorization of top 100 and the next 150. That's going to be, frankly, I think that needs to have been dispensed with a long time ago. Ultimately, people should invest in market leaders, whether their market cap is 1,000 crores or it's 10,000 crores. It doesn't really matter. But having said that, I think you'll find a lot of mid caps, which is where the value will be, which will continue to sort of make new highs when it's not very clear, other than the fact that they have survived, that they have done their own internal funding, that they are not short on debt, that they have access. So for good companies today which can demonstrate a decent balance sheet, there is no dearth of debt. And you can negotiate terms, you can get, because banks ultimately want to lend. But for a lot of the sectors that we get to see, including the capital intensive, the infra, etc., tying up debt is absolutely vital. And where companies we've seen recently go from AAA to D in a month, who is to say that a one-day default will not break everything up? So I think there's a lot of, and equity, as the word itself suggests, was meant to be the buffer when times were tough. It was meant to be the cushion that banks had to dip into. And, really that's the hypothesis that's, in this Swachh Bharat sort of clean out. I think we've really cleaned out so much that we've, in a sense, overshot this. But, none of us is really complaining or cribbing. At least for the advisory ones like us, we are in the advisory space for whether it's equity raising or it's restructuring. I think business couldn't be better. Because today people are literally, borrowers are today really scared because today that the lenders will not stop at any length to recover their money because they're emboldened to do so. And by the same logic, if the lenders in the PSU space get emboldened to lend, I think we are on a good wicket. So I think the worst is played out. And we were on your channel about 4 months ago, and I said, forgetting everything else, July, August, the market's bottomed out. Yeah. And I said, just add 6 months to it. Again, go back to good old theory that's lasted, for the last 30 years. Add 6 months, come December, January, you'll start seeing green shoots. What will lead to the green shoots? I don't know. But will there be green shoots? And you're able to see green shoots today. There are a number of pockets.
Cement prices.
Steel, cement, there's infra activities, new orders coming. I think there is some activity here which is indicating that the economy as a whole is turned. So the real truths are beyond all these, beyond this noise, the signals are that the market did bottom out and tell you that the economy will turn December, January. That's happening. Can the government use this to, I would say cut interest rates further? 2/3 of the world is still negative interest rates and thirsting for yields. We are in a happy position that we are searching for inflation and probably getting a little bit of it. Well, the rest of the world would give their right arm to have some inflation. So given all that, I think there are some tailwinds which the budget is going into. So the policymakers can realize that, and between them and the RBI, I think they can stoke this economy back into, if not a roaring economy, but at least definitely a more, prosperous looking economy than what we've been seeing, where everybody just would come to you and say things are terrible. And that's the echo chamber that we need to step out of, by the way. In the last 3 months, literally, you would have seen this on your channels. Everybody came and said it's terrible, and you kind of convinced each other into believing it was more terrible than than you could imagine.
It's like that famous American economist. He says that you can walk yourself into a recession.
That's correct.
And that's what is happening.
Well said. I think that's absolutely correct. So that's the echo chamber of depression that we need to step out. I've been categorized a perma bull forever in life, and I still believe that the big bullish takeaway is that the cleansing of business and the ease with which you can do business if you've got a decent balance sheet has never been better.
Sure. Okay, 5 quick tips for the finance minister. How can she try and stoke the economy back to recovery?
I would still say that GST cuts is not part of this thing, but somewhere along the line, consumption needs to get stoked through. I would say through tax cuts, indirect tax cuts. It's been seen in the past that when GST rates were tweaked around, it's the manufacturer who tweaked his his little numbers, but did not pass on the benefit. But I still think consumption will take off. That's number one. Number two, I think there needs to be a no holds barred divestment. I think the government has tried its best. They've tried to be cute about holding on to this, asking ONGC to bid for BPCL, etc. is too cute by half. I don't think we really need to go down that path. I think we just need to say we don't have the money. We are putting these out for sale. These PSUs today are quoting at absurd multiples. They're quoting at 10, 12, 14% dividend yields, and there are no takers. So I think the real solution is to say we can't do this. Between sale of excess land and sale of corporations, I think we can literally finance our way out of this entire thing. We can recapitalize banks with the same money. We can do whatever. We can finance infrastructure. We can put in all these wonderful bullet train kind of projects. So I think there's no dearth of money, but there's just too much money locked up in this particular thing. So at the risk of repeating what the government has been saying, we need more governance, less government. And I think we need very little government in these areas. So forget 5, just these 2. If divestment is a no holds barred, forget 50,000 or to 80,000, put in a target of 300,000 crores. So you'll be forced to divest. That's the only way to do it. I mean, I'm heartened to see, I hope it's not too late, that Air India, now the 100% is being offered. I mean, this could have been done first time around, right? What has changed in Air India other than it getting dramatically worse over the last 18 or 24 months?
The market share is in single digit now. That is at 60,000 crore. I mean, they have some of the most outstanding bilateral rights is what I've been told.
That's correct, absolutely. So you eliminate the debt. They've got real estate that can take care of 50% of the debt. And they've got routes that can take care of the valuation. So this was true 2 years ago, this was true 6 years ago, this was true 16 years ago. All you have done, whether it's MTNL, VSNL, Air India, you've in a sense run them to the ground and then say we are going to divest. And then guess what? People aren't willing to take it up. I mean, that's a no-brainer, right?
Jakes, really appreciate your time. Thank you for joining us. We've covered a range of topics as always, and I always look forward to these engaging conversations.